Hey everyone, welcome to our podcast. This is Josh, Jake, and Nick with Wealthonomics. Once again, returning to the round table to bring you another podcast. And as always, you can check us out at wealthonomics.org or becomingyourownbank.com.
We got a good one today for you, folks.
And we're going to be bringing in a couple of different clips and different articles and interviews today, all dealing with the well-known Suze Orman.
Yes.
There's one thing I wish that we were able to get and that's a good list of sponsors, because I think that would have added value. But I think we got a lot of good content to talk about today. So
here we go. So we're going to start a clip here with Suze Orman talking to a fan that's asking her some financial advice.
Kathy,
Yes.
come and tell us from Waterford, Connecticut. You have a question for me.
I do. Hi, Susie.
Hi, Kath.
okay.
Yes, I sold everything in January. I couldn't take it. My stomach was in knots.
Then why are you sighing, girlfriend? January was many months ago. You actually got out pretty close to the high. Remember, the high of this stock market was October 9th or 10th of 2007. We're at 14,000. In January, that was the most brilliant thing to do. So why are you so upset?
Well, because now I don't know what to do with it. It's sitting there in a cash investment trust account in my 401k.
Yes.
And I don't know what to look for in the market to get back into the market. When will the time be right? How do you know when you've hit the bottom, and how do you know what to get into and what's safe and what you can stomach?
All right, so here's the question for you. You're how old?
50.
All right, you're 50 years of age. How long do you think you have before you reach?
So that kind of just sets up where we're at, right? We've got this lady, Kat, right? Right? That's her name?
Kathy.
Kat. So we got this lady, Kathy, right? And
she's 50.
She's 50. She's in the market, right? And then she pulls out just before, a couple months before it goes real bad.
Basically at the perfect time.
Perfect time.
Yeah.
Right? And so she's got a really good problem to have here. She's got money that is now in a safe location that didn't get hit by what most people experienced in 2008.
And it's funny to hear her talk about her experience before she got out. The reason that she got out is because she couldn't stomach it anymore. She couldn't handle that. She probably wasn't sleeping at night because she didn't know what her money was going to do.
I wonder what it would have been like if she had left it in another year. She would have really been sick to her stomach.
Well, yeah. So let's jump ahead to where she answers her question.
What I would be doing if I were you is I would be dollar cost averaging back into the stock market.
The one thing I want to point out here, right, is she says the words,
what I would be doing if
I
I were you.
What I would be doing if I were you. What I would be doing. Okay, let's keep it going.
What I would be doing if I were you is I would be dollar cost averaging back into the stock market at this point in time. But I'm not sure I would be doing it 25%, 25%, 25%. I would be doing it since you got out of the market and you've been out for a while and we don't know if the markets are going up or down from here. I would be doing whatever amount of money that you have on the sidelines. I would be dividing that amount of money by 12. Let's say it's $120,000. If you divide it by 12, that's $10,000. I would be putting $10,000 a month back into the market over this next year.
That's all her money.
I would be dollar cost averaging that way. If the market goes down, that $10,000 buys more shares, because when the market goes down, the price per share of whatever you're buying normally goes down. The more those prices go down, the more shares you're able to buy. If the prices go up, the less shares you're able to buy, but your dollars actually average over time, and no matter what happens, whether we go up or whether we go down, you will be okay. The biggest mistake that you will make is if you stop contributing to the stock market at this point in time within your 401k. Now is the time to continue every single month to be putting that money into the stock market. In fact,
Okay, so
go ahead.
So I just
what's the key word there?
Well, there's a lot of keywords there, but I'm going back to what this lady says, Kathy. I couldn't stomach it. And now the advice she's getting from this quote-unquote professional is to what? Go right back at it with all of your money. And over the next year, stick all of your money right back into the place that you couldn't handle and is why you got out.
And she says, and this is the key word to me, is, well, maybe we'll have to replay it to get the exact quote here, but the biggest mistake you will make is to not put your money back in the market.
Well, and this idea of dollar cost averaging, it's such a great way to sell this idea, because that is if the market goes up, you're making money. If the market goes down, you're buying more shares. So how could you lose?
Right.
But realistically, if the market's going down, you're losing money. I mean, on the shares that you've already bought. And the idea is that it's going to go back up, it's going to go down. But realistically, then you have for a year at least a percentage of that money, if, you'd have to do the math over every month, but you're losing out on whatever that money would have grown to. Every time, so you're basically spending a year to get your money back in.
Yeah, it's a way to say, the losses aren't bad, right? It's a way to kind of cover the impact of those losses by emphasizing the fact that actually you're just going to get those purchased at a
you're
better.
Guaranteeing yourself an opportunity cost lost. And I know maybe that's too deep to get into, but you're guaranteeing that year you're going to lose out on a majority of what their money would have grown to in that year.
Yeah.
Well, you got to imagine that most people that, this is an average lady, I feel like, that's got a 401k, and most people out there that get financial advice are probably being fed some of this dollar cost averaging idea. So there's got to be just thousands of people out there implementing the same concept. Why don't we have more millionaires from people that have invested in the stock market?
From diversification. Why doesn't everybody have a 401k just retiring early?
Yeah, that's what and that's the thing is it all sounds so great, but it doesn't work. You know what I mean? This lady, she hit this at the perfect time, right?
She got lucky.
She I mean, I'm not under. It's unfortunate
she
that
made some good decisions.
Yeah, she made good decisions, and it's good that she got to that point, but it was just a matter of luck, really. Had she ended it a couple months later, she'd have taken a huge hit out of that. And that's what we all face, is inability to predict what's going to happen in the future. And so they have all of these ways of, this is good because of this. You just buy more shares. It'll all average out. That's just really not what happens. It doesn't work in your favor that way.
Yeah, and let's just kind of play a what-if scenario. If Kathy had called Suze after maybe she decided to leave that money in for 5-6 more months, and she got hurt really bad, and then she called Suze Orman, what do you think Suze's advice would have been then?
Well, here I'll one-up you there. What if she would have talked to Suze Orman before she took her money out and said, hey, what should I do? And Suze said, keep it in the market, right?
Put more in.
Put more in. Dollar cost averaging, she'd have taken a huge hit on her money.
Yeah.
Okay, so it's really just a way of saying, look, let's mask the impact of it. But anyway, let's kind of move on from that.
Yeah.
And the reality is that's a very it's a scary advice, to just continue to keep putting money in the market. This lady, Kathy, she's been in the market just like thousands and thousands of other people out there are right now, and it made her stomach turn because it's not a pleasant experience.
There's no control.
It's becoming less and less pleasant, and there's a number of reasons why it's not an attractive thing to be, a part of right now. But just look at the last 10 or 12 years, and people have been riding a roller coaster with really with no reason to be doing so. Nothing to show for it, I guess, is the way to say that. But
let's backtrack, and Jake emphasized this a little bit. It's the key word of what I would be doing if I were you. Suze says this.
Well, let's ask her.
And that's really what
let's ask her. Actually, I know someone that can. Can we get a name on this? Anybody? Let's see if we can get a name on here.
Somebody asked her that very question.
Someone's just as interested as us. Deborah Solomon. Deborah from New York Times. Sat
down with Suze.
She sat down with Suze, asked the questions that we would want to know, and I think that Kathy, I guess, might have thought she knew because it's what, and she was giving her the advice that I guess you would assume she was doing as well. But I guess we'll see what Deborah came up with. But yeah, let's take a look at this interview that Deborah did with Suze. Anybody want to give this a go? A lot of good stuff right about to happen. So
Yeah. Well, where do we want to start here?
well, let's talk about this first question.
Okay. So it was Deborah, right?
Deborah
Deborah asked the question, how much are you worth these days? And the reply from Suze, one journalist estimated my liquid net worth at $25 million. That's pretty close. My houses are worth another $7 million.
She's got some real estate.
Okay, so
right?
she's got
I'm
some
guessing that's not her primary residence only.
and she's got $7 million worth of real estate. Okay,
It's either
that's a
a
lot.
really, really nice house, or she's got some investments. Right?
Okay, and liquid net worth of $25 million. So money she can move around essentially.
Right.
Okay.
Emphasize liquid.
Yeah. Next
Yeah,
question
that's a good
asked by Deborah. What are your qualifications for giving financial advice? What do you do in your books, your column in Oprah's magazine, and your CNBC television show? And then Suze answers, for 7 years after college, I was a waitress at the Buttercup Bakery in Berkeley, and from there I got a job at Merrill Lynch as an account executive, from where I went to vice president of investments for Prudential Box Securities. And then she started her own firm in 1987. Okay, so giving herself a little bit of background, building herself up a little bit. And then next question from Deborah, do you enjoy spending money? Suze answers, oh yes. My greatest pleasure is still flying private. I spend between $300,000 and $500,000 depending on my year on flying private. Okay.
Thanks, flying private. That's great. And
great.
we have nothing against her making a lot of money. That's great if she's making a lot of money. The question is, what is she doing?
Okay, so
with
tune in.
It's where it gets
This is good.
Here it is.
So Deborah asks, what do you do with the rest of your money? I love how blunt Deborah is. And Suze answers, save it and build it in municipal bonds. I buy zero coupon municipal bonds, and all the bonds I buy are AAA rated and insured so that even if the city goes under, I get my money. I take a little lower interest rate to make sure my bonds are 100% safe and sound.
Okay, I can't even move on to the next question yet. This is huge. I mean, this is a I don't know the best way to say something of extreme value that is probably rarely seen.
Yes.
This interview is just tremendous to me. I love this. She buys, so she's got $25 million, right? And
liquid money.
dollars, right? She likes liquidity. She puts money into municipal bonds, which are AAA rated, extremely highly rated, right? Pretty much guaranteed to pay out, right? She says, even if the city goes under, I get my money. And here's the kicker. I take a little lower interest rate to make sure my bonds are 100% safe and sound. Now, let's look a little bit more into when this article was written, right?
Okay.
Deborah Solomon published February 25th, 2007.
So
if there was a time for someone like Suze to be in the market,
To
that
be
would have been
benefiting from high yields in the market.
Yes,
that's the
that
time.
would have been it. This isn't, oh, the market's crashed, this is what I'm doing now.
Yep.
This is, hey, the markets seem to be great, and I'm gonna. You would think I'm taking advantage of those gains in the stock market, right?
Right, and one more thing to mention on this question. The very first word she says is save. What do you do with the rest of your money is the question. First thing she says is save it. She doesn't say invest it. She doesn't say, go after those, 12% returns.
Her money's in safe money.
yeah.
Okay. And then the last question, this kind of wraps it up. Deborah asks, do you play the stock market at all? And Suze answers.
Hold on. So she's got $25 million liquid, right? That she can use.
Well, I think Deborah's thinking the same thing that we are. She receives this answer of all my money is safe in municipal bonds. If the city goes under, I get my money. So she asks the obvious question. You're telling all these people to play the stock market. Do you do it?
Right.
Right?
Do you play the stock market at all is the question, right?
And the answer, quote, I have $1 million in the stock market because if I lose $1 million, I don't personally care. Cut.
I mean, do we want to just wrap it up there? I mean,
We might as well.
What else can you say? This is just incredible. She's
So,
got
go ahead.
$25 million, right? $1 million is in the market. Why? She's not doing dollar cost averaging. She's not buying every month. She's not continuing to invest in the market because, if it goes up, I'm going to make money. But if it goes down, I'll be buying more shares at a lower price. No, she puts money in the market simply because she does not care if she loses it all. And here's the thing that gets me the most. That is some great, sound financial advice.
Oh, yeah.
She has a great financial advisor, whoever that is, who should be on the radio. But that is some great advice, right? She's got 24 over 25 million in safe funds, right? She's got other funds of some sort that are locked up into real estate, right? A somewhat safe investment, or at least an investment that she has control over. And then she's got $1 million in the market because she does not care if she loses that money. That is a great financial plan. Why is that not what she's telling everyone else? Why is Kathy putting all of the money that she pulled out at the perfect time? Why is she putting that back in the market over the year every month?
Well, it's a pretty simple answer, to be honest with you, because I think we should answer that question. Why isn't Susie giving the advice that she's implementing herself? It's because she's being controlled by huge media conglomerates that are essentially making money off target date mutual funds, off 401ks. That's why.
She just has her hands tied. She may have started with those beliefs and preached those beliefs for years, but over time her own financial plan has developed to where she really believes. That's where the truth is, right? Where she's proof is in what she's actually doing. And I think that's what she's really developed in her, and she's really come to believe. But she's so committed in one direction, hands tied, working for these large companies, media companies that are owned by all of these asset management groups. Has to sponsor. That's why I said I'd love to know who these sponsors are, because she's obviously got to push these sponsors to some degree. But it's just the reality is what she believes is what she does. What advice she offers is different, and that's why all of these talking radio heads are they have their hands tied. That's why I say all the time, I'd love to see what Dave Ramsey really does, because this is along the lines of what I believe he would be doing.
Well, let's call Deborah, and
maybe she can get an interview.
She can get an interview with Dave as well. Anyway, that might be the case. To a certain extent, they may have basically tried to convince themselves that this is what's best for the American people, because that's who their general audience is. I don't know, though. I feel like
I think it started with good intentions.
I think it did, but at the same time, what is good intention then might not be working now, and I think that needs to be communicated.
Yeah, I agree. It's like I said, we really should just read these again and end it, because it says it all. She says exactly what she tells you a great financial philosophy.
Yeah,
safety, guarantees,
liquidity,
liquid. Yeah, 100% safe and sound. She even takes a lower interest rate to ensure that safe. She's all about safety. She's all about guarantees.
Well, and that's the idea that maybe she should be toting is that, man, safety is much more important than getting a better interest rate.
Well, she flip-flops these ideas when she preaches versus what she does. She says invest first, essentially. I mean, maybe besides an emergency fund, right? I'm not suggesting that this is all she preaches, but she's investment first, put your money in the 401k, and then maybe her philosophy is once you make it, you have all this money, then you can go to safety. Whoa. That should be exactly the opposite. Safety first, and then, she says it right here, right? I have $1 million in the stock market because if I lose $1 million, I don't personally care.
Well, what's funny is
don't put it in unless you don't care.
I think it's funny because she even has a pessimistic outlook on the stock market itself.
Because in 2007,
if I was going to make that a comment that I had money in the stock market, I think that would give away what my true intentions were. I have $1 million in the stock market so that if I hit a home run, it's going to just become huge.
Right.
But realistically, she says, if I lose it, I don't care.
So she's basically...
She assumes the loss.
Well, yeah, she's assuming the volatility,
she knows,
which is
she knows if it's risky that she could lose it. And she doesn't... Her foundation...
It's money she acts like she doesn't even need.
Yeah, exactly.
And that's the way it should be.
And that's why this is actually really great financial advice from Suze Orman. Hey, keep your money safe, most of it, and then what you don't care about, what you can afford to lose, gamble it away. If you want
so
to.
what? Like 95% of your money in safe reserves and 5% of your money in something that's going to be volatile.
Exactly.
Yeah.
96%.
And the volatility, you have to assume that you could lose it all.
Yep.
Yeah, I mean, I'm just throwing numbers out. Yeah. But that would be what seems to be a, pretty good strategy on her part.
And it's funny, actually. I like how this is developed because she's actually giving you some really good advice by showing you what a wealthy individual she's wealthy, right? She flies she loves flying privately. She owns a lot of real estate. I'm sure a lot of those, are vacation homes and that sort of thing for her. I mean, she lives a great life. She's a wealthy individual, and she's giving you some great advice as to what she does. And she lists them all, right? Guarantees, safety, liquidity.
It's funny because people like that have the money to lose. The ordinary American doesn't have money to lose.
They should be far less inclined to be.
They should be 99% safety, 1% risk.
Exactly. If any risk. I mean, really, risk is money that you can afford to do without. And, it's just funny to me that people go to the stock market first. I mean, you're just as good, if not better off, going and just trying to start a business.
And that's the other thing. She's got and she's really doing a great job at showing what wealthy people do, right? She's showing that they keep their money safe, sound, liquid, all those great things. But she's even got $7 million in real estate, right? And she's got her own business. This is the way that people become wealthy. It's not because they put their money in the stock market and they became wealthy, and she's proving that right there. She knows that. She's willing to gamble that money away because it's of really no value to her, other than, hey, if it does a good job for some reason, I'm going to take advantage of that. But she doesn't care if she loses it. And so she's really doing a great job showing that, I should put my money in some real estate, because I have a control over that, and that could, appreciate it, and income and rental income. I mean, there's a lot of reasons why that's a good option, and owning her own business. I mean, a lot of these things are really, showing you that this is how people become wealthy. But it's just unfortunate that her career involves helping people do exactly the opposite of that.
Exactly the opposite.
Yeah. And I mean, we don't want to beat a dead horse. We're just we really think this right here, this interview, and we're going to put a link to this up with this podcast. I think you have to register for New York Times website, but if you want to see this article, and you do, you'll go and do it. But this article right here is great financial advice for anyone from Suze Orman, and we just wanted to point that out and hope that it was helpful for someone out there.
Yeah. And
kind of makes you sick a little bit.
It does make you sick. And I think we try to give her the benefit of the doubt because we don't want to sit here and bash on her whole career. But reality is she's putting people in a very poor situation where she's teaching them to really fund all of these asset management groups, fund these banks, buying insurance, all these sort of things that really are benefits to her sponsors, but really not beneficial to her listeners.
Yep. All right, everyone. Well, thanks for joining us on this podcast. As always, send any comments or questions to info@wealthonomics.org. Also, if you're an avid listener, we really appreciate your comments and your ratings. Thanks for joining us.